So President Trump is tapping into a real frustration, but limiting investments won't solve the real problem. They won't move the needle. Man, oh man, there's a lot to talk about with respect to housing policy, housing trends. Let's take a step back. One of the major headwinds keeping home sales low was the lock-in effect. And that was the idea that somebody, and a lot of people, the majority had 3%-ish mortgages and didn't want to trade out of their house and then get a 6.5 or 7% mortgage. But now mortgage rates have come back down, and we're in an environment now where more people have a 6% mortgage than a 3% mortgage. So the lock-in effect is greatly diminished now. I think that's going to be generally very positive for home sales. Now, what's adding to that is that Trump has said that Fannie and Freddie should start buying mortgage-backed securities. These MBS purchases are already going on. He wants to greatly accelerate them. As soon as he made the announcement, mortgage rates fell from the low sixes to just a hair under 6%. They've come back up a little bit since then, back up into around 6.2 range. But nonetheless, if this program really gets rolling, then, and if it gets sustained, because the Fed is going to change leadership soon, and that's going to probably open the door for more of these kinds of open market operations, quantitative easing, depending on what term you want to use, but it could keep interest rates in that range between 5.75 and 6.1 in the future. Let me show you a graph. Okay, this graph shows you the breakdown over time of who owned how much MBS. Fannie and Freddie MBS holdings had dwindled since they failed and went into conservatorship, and very little has been maintained on their books, but they have added about 69 billion in the last half of 2025. And like I said, with the change in leadership that's coming at the Fed, it opens up that question is sort of gold-colored shaded area at the bottom there. That's the Fed's holdings of MBS. And that's been dwindling slowly, but still a huge amount. And Powell was saying we should have started shedding some of this inventory of bonds a lot earlier. But nonetheless, with the new leadership, it could be that they'll buy more MBS, and that could keep those interest rates down for a longer period of time. So then that kind of leads to the next question is, will this increase or decrease home prices? Well, in order to answer that, first we have to figure out the impact on sales from this shift. So first of all, with lower interest rates, it looks pretty clear that more sellers will come to the market. Listings on the multiple listing services will increase because there's less of that lock-in effect. Mortgage rates fall, the less the lock-in effect still has a hold on people. So for prices, we have two different directions that are going to be going on at the same time. There will be an increased pressure on prices to go higher because there will be two different forces operating against each other in terms of home prices. First of all, there will be upward pressure on prices because just by the fact that more people will be able to afford the monthly payment on a home, that'll increase demand, and that could put some upward pressure on prices. But on the other hand, because we just established that more listings are going to hit the market, that's going to create more supply, and that would tend to have a downward influence on prices. So my take is there'll be just a slight bit more net upward pressure on prices, and I expect to see prices move up at roughly around 2.7 to 3% this coming year. Let me move on to another topic, which is another policy remedy that's being discussed, and that's the 50-year mortgage idea. So real quickly on this one, 50-year mortgage will perhaps lower the monthly payment because you're spreading the payments out over more time. That seems pretty easy to grasp. But the problem is you have to take into account the term premium on interest rates. That is to say, a longer term on a loan carries with it a higher interest rate. So a 15-year interest rate on a mortgage is lower than a 30-year mortgage rate. And then if you go to a 50-year, it's going to be above the 30-year rate. So it doesn't really have a great deal of impact on what people can afford. So I don't know that that one's going to go anywhere. Another policy move that I've heard announced is the ban on SFR purchases by large institutional investors. Let's back up and say, yes, affordability is a problem, but this is not the solution. Let me show you a quick clip from an interview that I did immediately after this announcement happened.
Joining us now is Brad Hunter, President Hunter Housing Economics. And so obviously we've had this announcement in the last few hours, President Trump talking about house ownership. I'm just wondering, what was your initial takeaway from that?
Yeah, Sam, thanks for having me on. Affordability is a problem. People used to be able to buy their first home when they were 25, then it went up to 28, 30. Now it's 40 years old before they can buy their first home. So when you dig in, you learn that the institutional investors are not the cause of the problem. They only own 3% of all the rental single family homes in the country. So President Trump is tapping into a real frustration, but limiting investments won't solve the real problem. They won't move the needle.
So this doesn't move the needle, and you highlight that these institutional investors only own about 2 to 3% of these single-family homes nationwide. Why do you think they loom so large in the public sphere when their footprint in reality is so small?
Because the headlines are attention grabbing. You see Blackstone bought this many homes, that many homes, Invitation, AMH, JP Morgan, et cetera, et cetera. And it all sounds like it's a big trend in the market. And it's an interesting trend and it's real, but it's not big enough to swing the market one way or the other. Matter of fact, a lot of the institutions are now net sellers of homes.
Interesting. Okay, so, as far as moving the needle, maybe not a huge amount, but what does fix the anxieties around affordability right now in the housing market? I mean, what's the solution here?
We need more supply. We're undersupplied in this country by somewhere between 1.5 and 2 million. There's some estimates that are higher than that, but I think that's the more realistic one. And that's a lot. We're undersupplied. So, what are the solutions to getting more supply? Well, maybe less reliance on impact fees, but that's a local government problem. But the main thing is we need to build more homes, both for sale and homes that are built to rent. A lot of the companies out there that are doing build to rent homes are adding supply into the market, and that's what's really needed. So that's a different kind of business than what President Trump is talking about constraining right now. That he wants to constrain these companies from buying new, additional homes. But that gets complicated too because um, AMH buys from its own in-house home building company. So how do you handle that? Does that count as part of this? What's going to be limited? I don't know. That we're still in early minutes here trying to figure this out. And then what about big mom and pop investors? Are they going to be limited, or is it only publicly held REITs and so on? How do they define that? So there's still so much to be thought through and defined before this can really become a policy.
And Brad, if it all boils down to supply, let's dive into that. How big is the housing shortage in the US and how long has it been building for?
Yeah, so it's about 1.5 to 2 million that we're short relative to what's needed. But each year we're building fewer homes than what are demanded in the marketplace. Now it's gotten a little softer in recent months, and builders are seeing less absorption per project or sales per project right now. But overall, we're still falling short of what's needed on the single family side. Now, an important point that I made in that interview, and I want to stress even more, is that the institutions are net sellers these days. They're not out there buying up homes and competing with the general public that would like to buy homes and purchasing those out from under them. This graph shows some of the biggest institutional investors and REITs, and talk about Blackstone here, that's associated with Tricon. Blackstone has reduced their holdings of single family homes by 20% over the last decade or so. Invitation Homes, Progress Residential, look at Home Partners of America. These bars below the line are the dispositions, whereas the acquisitions are the gray bars that are above the line. So, on balance, they are selling more homes than they are buying. So, they are clearly not driving the problem. The other thing to recognize is, as I said in that interview, about 3% of the single-family rental homes are owned by large investors. The vast majority are owned by individual mom and pop owners. Only about 0.5% of all the single-family housing stock in the country is owned by institutional investors. So I'm going to bring up another point here, which is data specifically for AMH, one of the biggest investors in single-family homes in the country. And what we see on this most recent bar on the far right here is that they're buying a little bit, building a lot. And that's the important thing here. They're also disposing of a lot of homes. But that build to rent component is extremely important because that is part of the solution to the problem that we're facing. The problem is that we're not building enough. We need to build both more for sale homes and more homes for rent. Bear in mind the important point here about BTR. Build to rent is just what it sounds like. They're building more homes. They're adding to the inventory. They're not taking away supply. And we need more of that. We need to build more homes, both for sale and for rent. I'm Brad Hunter. Stay in touch. We'll keep monitoring.